Hello everyone. This channel is all about showing how I make money selling cash secured puts as well as covered calls, mostly on the leveraged products. When it comes to covered calls or cash secured puts, when the contracts goes in the money, is it easy to roll the contracts? I always hear, yeah, we can always roll the contracts. Rolling contracts is nothing burger. It is always easy. We can roll however we want. But there are a couple of complications. It is not always easy to roll the contracts. That is what I want to show you. I want to show you a couple of examples and what I am doing, what I learned, and how I am managing my contracts, and how I am going to play with my contracts, whether it is covered call or cash secured put going forward. First, let me start with when it is easy to roll the contracts. The contracts are very easy to roll if the stock price stays close to the strike price and the volatility is still a little bit high, decent to high. Then we can roll the contracts, and it is pretty easy to roll the contracts. If you saw my recent video, I already rolled two contracts. One is MSTX and one is ETHU. ETHU was little difficult, but MSTX was easy to roll. If you watched my previous video, you already saw that I rolled MSTX. This was pretty easy to roll because my strike price was 53 and the stock price was about $61. So it was easy for me to roll from 53 to 60 just by moving the contract 2 weeks out because the volatility was high and the stock price is close to the strike price. So that is the only situation. Rolling is very easy. Rest of the cases, rolling is not that easy. Yes, we can definitely roll it, but we have to make some compromises. Let me show you some examples. I'm using my other account to show you this example. So in this example, I want to walk you through my Tesla journey. I have a bunch of Tesla stocks and I wrote a couple of covered calls. So I'm going to take one covered call and use that as an example and the difficult journey I went through. I wrote a covered call on June 17th, 2024. Let me show you the stock price on June 17th, 2024. So here on June 17th, 2024, the stock price was $187. If you look at the history, the stock price was pretty flat for a long time, from March 6th all the way to June 25th. The stock price was pretty flat. Because the stock price was pretty flat at this $180 range, I thought of writing a covered call at $200 or slightly above $200. So I chose $202 covered call. That is just within 2 or 3 weeks. I didn't expect that it will go from 180 to 200 in that 2 to 3 weeks period. But just overnight, it spiked heavily. So not exactly overnight, but in probably 2 or 3 days, it went from 180 all the way to 263. This was a huge spike. So with that, my contract went in the money so quick. Since I didn't have the intention of losing a Tesla stock at all, I did a roll. So I rolled the contract from 202.5 to 215, but to gain this little bit of rise, it is just $13 up, $12.5 up. I had to roll 1 month out, which is not really bad. But the mistake I did is rolling out to just 215. I collected a lot of premium here, but instead of collecting all this premium, I should have rolled it to higher price, but I didn't do that. Now, if I look at the stock price for this 816, on 816, the stock price was 216. If I kept this contract as is, I wouldn't have lost any money because the stock price was super close to my strike price, which is 215, and the stock price was 216. It is just $1 difference. So I could have easily rolled this contract without losing a lot of money. But when the stock price was going up and up, I'm really scared. So I immediately rolled again. So I rolled from 215 to 260 by pushing the contract to nearly 4 months out from 816 to 117. One way this is not a bad move because we never know how stock will move, whether it goes up or down or sideways. So it's hard to predict, especially the stocks like Tesla. So I got panic and I rolled out. If I didn't roll out, that would be a better thing. But because I rolled out, I had to wait all the way to 117 without doing anything. Now, if I look at 117, this is basically 2025. And you all know what happened to stock at the year end of 2024 and the beginning of 2025. So, if you look at this, by year end, it went all the way to 480. So, I got panic again and I thought I will definitely lose the stock. So, I did roll again. So, 260, 117 call. So before I even hit 117, because the stock was skyrocketing, I rolled out from 260 to 285 by pushing 4 months out. I was in December, I think I did this in, not even December, like I did this in November and I pushed from 117 to 417 just by increasing $25, 260 to 285, just $25. I also didn't get any premium. Look at this. This is just $30 of premium collection, but I did this to protect my stock. But the stock never stopped. So I had to roll this 285 again because the stock was skyrocketing. Now let's see one more roll I did. So at the beginning of January, I rolled that 285 417 call all the way to December and I was only able to rise the price up to 330. If I roll it to probably mid 26 or end of 26 or at the beginning of 27, I could have rolled it to 400 or 450, but I have to lock these shares for a really long time and we don't know what happens in next 1.5 to 2 years. So that is the risk basically. So we can easily roll. One way we can say that it is easy to roll, but see here, we are pushing way out. That means we are blocking our capital for really long time. So if we don't care about locking the capital for a long time and don't worry whether the Tesla stock price come back or go up. So if you don't care about anything, this is totally fine. But definitely we are locking the capital for a really long time and this capital do nothing because whatever the Tesla stock price is, you are selling at 330. Whether the stock goes to 800, 1800 doesn't matter because just to sell at 330, I am locking this capital all the way to December. If I want to go up, I would have locked this capital at $400 probably for another 2 to 3 years. So that is the risk basically. Let me show you one more example with Shopify. Writing covered call on Shopify was a big mistake because Shopify recently didn't have any volatility. So let me start with my initial covered call. So in September, I wrote a covered call for $80. The stock price was, I think, around $60 that time. And I wrote a covered call for $80 and I collected just 170. But during this time frame, I wrote the covered call on September 11th for the contract that was expiring on October 18th. That is just 1 month and 1 week out. Just within that 1 month and 1 week, the stock price spiked. So I'm forced to roll the covered call. But luckily, I was able to roll the covered call a little bit easy. So I bumped up from 80 to 90, pushing just 1 month out. So this was definitely easy. But after that, the stock continued to rise and I had to roll again from $90 to $92 by pushing about a month out. So this was also fine because the stock price stayed about this range. But after this, the magic happened and the stock price skyrocketed. So again, I didn't want to give up on Shopify stock because in fact my average price was way above $100. So definitely I didn't want to give up these stocks at $92. So if I give up shares at $92, I am selling the stock for loss, which I didn't want to happen. So for that, I had to roll the contract. So I rolled it far away from here. So from 1213 all the way to 620. I had to roll out this contract to 6 months away by increasing only $8 from $92 to $100. Just by locking $9,200, I am only gaining $800. But I was just stubborn to hold these stocks until it reaches profitability or at least my break even. That's why I had to roll out this position, but definitely this was not a happy rollout. So I am locking the money. I'm locking this $10,000 for another 6 months here. If it stays close to $100, maybe I can roll out again and I probably reach my break even after that. But I don't know how long I need to log this. Shopify reached 120 recently. So if I don't have this contract, I could have sold my stock above my break even price. But because I am locked with this contract, I couldn't. So that is the risk I am taking here. What happens if Shopify stock goes below $100 again? Of course, this contract will be released, but definitely I will go under my break even price again. So I need to wait again. I have so many examples like this. I have probably more than 100 examples like this. Let me show you one more example where I lost lot of profit. This story is about Palantir. I'm sure most of you already know how Palantir stock skyrocketed in just a couple of months. So literally the last Friday, I had to give up 1200 Palantir stock at just $34. The current Palantir strike price was $70 plus dollars, but I had to give up this Palantir stock at just $34. I lost nearly $45,000 with this covered call. So I had covered calls at $34. I didn't see any easy way to roll these contracts. Even if I am okay to roll out all the way to 2027, I couldn't find any contract without losing the money. I really wanted to roll out these contracts because definitely I didn't want to lose these stocks at just $34, but I didn't see any opportunity. Even I'm ready to roll out these contracts all the way to 2027, but because my strike price was just $34 and stock price was $70, I didn't get any break even. So I was losing a lot of money to roll out even to 2027, and I'm not getting any good stock appreciation as well. So with that, I simply gave up these stocks. So with all these, I learned a couple of things and I wanted to share them with you. So these are my learnings. So my first learning is protect the shares. If you really want to hold the shares and don't give up the shares at any cost, always go with the strike prices which has extremely low delta, literally under 0.1 or maybe 0.15. Never go beyond that. So these extremely low delta strike prices will give very little premium, but that's totally fine. Actually, the rule number one is don't write covered calls if you really want to hold the shares. But if you want to get a little bit out of it, go with this low delta strike prices and collect that little premium. Don't be greedy at all. So this is what I am doing for all the stocks that I want to hold for a really long time. Majority of the times, I don't even write the covered call, but if the stock skyrockets on any day, I immediately write covered call and still collect only a little bit of premium. The second lesson I learned is roll up fast. If some good news came in and the stock price skyrocketed, roll the contract immediately. Don't expect the stock price to come back. Yeah, there could be a chance that the stock price may come back, but nothing is guaranteed. So it is always better to be on the safer side. So roll up fast and maybe roll out a little far and try to hit the higher strike price. Try to pick the contract that has extremely low delta because you're already in the money, you're already caught up. Don't repeat the situation with the roll. So go little far and go little high and try to get rid of the covered call. Once you hit the situation that you are out of covered call situation, you can probably write better covered calls later on, but first get out of the situation. The third lesson I learned is, in the worst case, if you don't see a lot of value rolling the contract, it's okay, let it assign and let the shares taken away from you, but immediately write more cash secured reports at your strike price or if possible below your current strike price. So that way, yeah, you will give up the shares, but at least assuming that your cash secured puts will be assigned and you get to keep the shares again. This is the worst case, but I always want to prefer number one, protect the shares. So always pick the very low delta, and in the worst case, if you still go in the money, roll up fast. So I strictly follow 1 and 2 and try to keep the shares that I want to hold. Alright, that is all I wanted to share with you. Now, this is a longer video, but if I want to explain these learnings, I really want to walk you through some of my examples. That's why it took long. Hope you found this useful. Thank you, and I will see you in the next video.